All right, looks like we got things set up here. Just making sure. Good morning, good morning, good morning. My name is Daniel, and we are going to spend time today in today's live talking about strike price. Let me just make sure everything is working for us really quickly. The chat is set up, so if you are in the session and you can hear my voice and you can see my screen okay and everything is working for you, do me a favor, hop into the chat, let me know things are working, and everything that I'm broadcasting you can see. If that's the case, we should be good to go here in just a second. You know, from a technology standpoint, I always want to make sure we are up and running and things are working as planned, and you can hear my voice okay. All right, thank you, Lorena. That sounds good, looks good. It's 11:31 a.m. Eastern time, so we're going to get things going here. Hey, Joanne and Sandra, looks like you guys are ready to go. Michael, all right. My name is Daniel. I'm with VantagePoint AI, and in today's session, we are going to spend some time talking about specifically how to improve strike price using options. I'll spend some improve strike price with options using artificial intelligence. Let me get the marbles out of my mouth here this morning. As you can tell, this is a live session, so as people get into the room, just drop in, say hello. I see that we've got Jacquez and Jimmy and Nancy and several people getting into the chat box right now. Thank you for being part of today's session. I'll spend some time today walking through how I use the artificial intelligence in VantagePoint to improve strike price selection. We'll walk through the details of that. And before I do that, though, let me just, while people are getting into the room, let me just kind of give everybody a quick rundown from an options standpoint. Not a whole lot of detailed education. I want to spend as much time as I can looking at some stocks and digging into the details, but I think it'd be good to get a good baseline of what we're going to be talking about here today. And first things first, let me just make sure we're all on the same page. This is an live educational event. In trading, there's a chance of loss. Trading is hard. Trading is risky. You've got to have good money management in place. That is key to success. Capital preservation, right? Always minimize your downside risk before you maximize your upside potential, because there is no perfect solution. And I may share some user experiences with you today. I'm sharing those with you through either the chat box or other ways that I hear them, and I'm not sharing them with you to say you're going to perform just like them, but I do like to share with you what other people have said, and we're going to spend all our time in our simulated environment here, right here in the VantagePoint software. All right, so as I said, we're going to talk about options trading with AI, and we're going to specifically focus in on strike price. But let's talk about for a second why personally I love options, right? The couple of reasons. The first one is it's like placing a bet on a stock. If a stock was going to decrease or increase or even remain the same in value, basically, I'm placing a bet on how much it's going to change in price and in what amount of time. Those two elements are fascinating to me. But more importantly, why I like options is because of the leverage opportunity, the liquidity opportunity. What I mean by leverage, I mean I can utilize a certain pool of money, let's call it $1,000, and control or have the opportunity to make more by using options. Right? Leveraging my gain, leveraging my capital to put myself in a position to make more money is attractive. And also, stocks that you can trade options on have lots of liquidity. There's a lot of liquidity in stocks. There's options traders buying and selling options on, and that liquidity gives me, personally, comfort. There's also unlimited profit potential. For you options traders out there, and I don't know how many we have in the room, if you are currently an options trader, go to the chat and just let me know that you're currently an options trader. But if you are currently an options trader, then you know what I mean by unlimited profit potential. If you are not an options trader, you can tell me that in the chat as well. But the reason I say unlimited profit potential is because using leverage of options and using options contracts to trade the markets, I could make 150, 200, 250% gains on a position in a very, very short amount of time when that underlying asset, that specific stock, doesn't gain 200% in value. That profit potential is attractive to me as well. Hey, Arthur, I love them too. Love options. Not yet for Jimmy. Okay. Bernadette's doing some options trading. Perfect. Okay, so we've got some options traders and some people interested in options in this session, which is perfect. I'll try to deliver, the information, the education level that everybody can follow along and understand. Also, protection. Options give me the ability from a protection standpoint as an investor. And this is something that a lot of traders like to do and, write covered calls and do different things to mitigate losses on a position, an underlying position I may not want to get out of. You may really like NVIDIA and want to hold NVIDIA because you've been holding it for years and you're not looking to sell NVIDIA, but when the price of NVIDIA drops, when the value of that stock decreases, I can buy some puts, I can sell some calls against my position, I can do different things so that I mitigate the loss on the underlying position and use options to protect that position. Very, very valuable use of options. Also, I love it because of the predetermined risk. I know how much premium, I'm paying. If I'm an options buyer and I'm buying a call, and I am willing to lose $2,000 every single time I trade. Let's say $2,000 is 2% of your trading account. And if I'm willing to lose $2,000 every single time I trade, because that's only 2%, well, then I can go find options that allow me to pay $2,000 in premium. And if that thing evaporates and expires worthless, I only lost as much as I was expecting to lose. That is predetermined risk before I ever get into the position. I can certainly trade more than that and use stop losses, a lot of different ways to do it, but I know going in how much I'm going to lose from a premium standpoint. Also, a very attractive reason why I love options. So just wanted to give you a little background information if you're not an options trader, why there's so much interest in options and why people like it. Moving on, let's talk about the different elements of options trading that are important to today's conversation, one specifically, because you got to remember, options trading is the practice of buying or selling options contracts. Those are basically agreements. An options contract is basically an agreement that give you the ability as the option holder to buy or sell the underlying asset at a certain price by a specific date, right? The price is the strike price. The date is the expiration date. There are three things that are really key in my mind to options trading. That is strike price, time to expiration or expiration date, and the current volatility of that underlying asset. The current volatility of that option based on expiration and strike price. All of that matters from an options trading standpoint. Now, we're not going to dig into all of that today. We're going to specifically focus on strike price today and dig into the details because that's one of the elements that you can use to change your premium. That's one of the elements that you can use to change how much money you make on that option, your risk. There's a lot of things that you can do by selecting a certain strike price over another strike price. So in today's session, we'll walk through that as well. Let's talk about the different strike prices and what the definition of a strike price is. For those of you that haven't traded options before, it's the price at which an option buyer can purchase or sell 100 shares if they exercise that option. It's the price that you believe that underlying asset is going to move to. If you're not, and I'm just talking about going long calls and long puts, basically buying calls and buying puts. That's the great thing about options is that you can use those two different types of strategies in a lot of different ways. But from a buying calls and buying put standpoint, there are three different elements that you need to know when thinking about strike price. In the money strike prices, at the money strike prices, and out of the money strike prices. Those are the three elements that I'm going to focus in on today. And depending on which strike price you choose, one that's in the money, at the money, or out of the money, that could change your premium dramatically, as well as the likelihood that you're right, the likelihood that you make money on that and how quickly you make money on that. There's a lot of elements that go into options trading, but strike price and determining a strike price that's going to set you up to be the most successful, or at least give you the chance at being the most successful, is a key piece of options trading. And the way I use VantagePoint helps me determine a strike price that can put me in the best position as possible, in my opinion. So we're going to walk through that today. We're going to dig through, actually, we're going to look at some charts right now and dig through the details on those charts before we dive in. But one thing that I just want to make sure we're on the same page about: there is always risk involved in trading, period. I've said this already once, and I want to make sure we're clear. Although we're going to dig into VantagePoint, I'm going to show you the artificial intelligence. We're talking about stacking the odds in your favor. And as a trader, you know that that's something that's important. So we're gonna do that right now. As a matter of fact, let me bring up my software program. Here we go. Here we go. All right, what are we looking at? We are looking at Ford Motor Company. And Ford Motor Company is a stock that I personally like. You know, I'm not making any recommendations. This is all education. But when I'm looking at Ford Motor Company, I can see that there's some really great trends going on. I'm going to grab a pen really quickly so I can, just kind of write on the screen and direct you a little bit there to make it a little bit easier for you to follow. Here we go. All right, so when I talk about Ford Motor Company, if I'm looking at buying some options on Ford Motor Company, the opportune time, the best time in my opinion to buy some options is at the point that that trend is expected to reverse. It's not the only time, but that is the most opportune time, especially when I'm using VantagePoint. For those of you that don't have or use VantagePoint, this deploys artificial intelligence to predict trends in advance, up to 3 days in advance, with accuracy up to 87.4%. So this spot right here on Ford Motor Company that happened at the end of the month last month is a key piece of how I use the artificial intelligence in VantagePoint, because when the blue line and the shaded area goes from red to green, right here, this is a crossover point. When that happens, this is the artificial intelligence saying that Ford Motor Company is expected to start trending up over the next few days. Well, as an options trader, if somebody that's interested in buying some calls, that's an important piece of information that I need. It's not the only piece of information, but it's a very, very important piece of information, because that is the moment that the AI is saying Ford is expected to start trending up. Now, it's also important that you understand when I say artificial intelligence, I'm saying artificial intelligence to its core. We've been using AI and neural networks now since 1991. We started developing this artificial intelligence in 1987 and released it for individual traders like you to use this information. This is a valuable piece of it, but it's not the only piece. This is the crossover point in Ford. Now, I also need to understand what the other markets were doing at this point, right? When I say the other markets, what I mean are the indices, the Dow, the NASDAQ, the S&P. Heck, I can go look at the SPY if you want to, and I can bring up the SPY right here on this point and say, all right, if here's the SPY, I need to see that the SPY was also bullish at that time, and I can see it certainly was. Well, if I know that the SPY is bullish at that same time that Ford was moving higher, we were on 825 on the SPY, here's 829 on Ford, well, then I've got some confirmation that not only was the S&P 500 expected to move higher, but Ford was also expected to move higher. So as an options trader, I'm feeling confident about the bullishness that I'm seeing on Ford on 829. Now, remember, you got to realize we're back in time on 829 right now. We're going to do some current examples, but I wanted to show you how to walk through this process. And if I take off the artificial intelligence, let me just do that for a second. I'm going to take off the artificial intelligence off the screen right now as we speak and just show you the candlesticks, right? If I'm just using the candlesticks, I don't really have anything to say that this is not the same trend up as this. I don't have anything to identify that this is when the trend is expected to start moving higher, different than this, or different than this, or different than this, which is why the AI is so valuable, because as soon as I layer on that artificial intelligence crossover, it tells me right there, right now, I've got an opportunity in Ford that I need to keep an eye on because this trend is expected to move higher. Well, if I'm looking to buy a call, because if a stock is expected to move higher, I would be looking to go long a call or buy a call. That's what it's called when I'm buying 100, basically controlling 100 shares with one call option. Now understand something. I don't need to do options on every single stock out there. And Ford, at the point that this crossover happened, was about 12 bucks per share, right? You may not need to buy an option on a stock that's $12 a share. But in this case, remember, one of my favorite things is the leverage. At this point, this call on Ford would have been about $1 a share, let's say. If I'm doing options, one options contract is 100 shares. Let me write that on the screen. It's 100 shares. So if at that point using options, it's $1 per share, then to enter that options contract, it cost me 100 bucks, right? This is a call option. Oh, I missed the A there, call. If I was to buy that underlying asset and get 100 shares at $12 per share, that's 1,200 bucks, right? Let me just do the math here. There we go. That's 1,200 bucks. So I can control the same amount of shares using an option with 100 bucks versus 1,200 bucks. I'm still controlling 100 shares. Now, what determines the fact that it's $1 per share times 100 shares in that option is a number of things, but one of those things being strike price. So let's walk through how I would choose a strike price at that point. On this day that we see the crossover, we can see that Ford closed at $11. Let me go back to it here, grab my pen. If you look in the top left corner, you can see the close was $12.05. $12.05 on that day was that close. That is the point that the artificial intelligence is saying, okay, this thing is expected to start trending up. Matter of fact, it was even the day before that. We can see the crossover there on the day before. We're going to use $12.05 as our point. Well, I've got an opportunity. Let me turn off the AI again for a second just to help you that don't trade options to understand this a little bit better. And I'm going to actually scroll on this to that point. There we go. This is the point. I'm going to mark a line right here on that screen, right there, and say, look, that's $12.05 roughly. That's the point that the artificial intelligence said, hey, this trend is expected to start going up. Bang, you see it that day, that night, 6:30 p.m. Eastern time. As an options trader, I can then go to my platform and say, okay, I want to buy Ford. I want to buy one contract of Ford at 12 bucks a share. That $12 a share, because strike prices are not going to be at odd numbers like 12.03. It's usually at $12. Some options may be at the 50-cent mark, $12.50. Other ones would be at the dollar mark, $13. Other ones might be at the 25-cent mark. Like the SPY has options all over the place. Ford, there's not that many selections. But if I want to trade Ford long and buy a call, I do have some choices. I can buy at the money, right, which would be $12. If I'm buying it at the money call, at the money strike price at Ford would be about 12 bucks because that is right where the underlying asset is, all right? If I wanted to buy out of the money, I need to pick, because I'm thinking this is expected to go up, I need to pick a strike price that is above. Let's call 13. Just for example, let's call it 13. Buying a $13 strike at Ford when it's at $12 might cost me 40 cents a share instead of $1 a share. Let's say this cost me 40 cents per share. Let me make that. And at the money, it cost me $1 a share. My premium in this situation at the money would be 100 bucks. My premium up here out of the money would be 40 bucks. So I can save a lot of money on premium by buying out of the money, but just understand something. If I select a strike price that is that far out of the money, call it at $13, for me to get in the money, for me to get all the value that I want out of that option, that share price, that underlying has to move up to $13 a share. Well, just understand something. Look at how many days it took to go from $13 a share down to $12 a share. That's like 3 weeks of time just on how this has been trending. That means it's highly unlikely that it gets back up to $13 a share very quickly, which means although that premium is going to be lower, I reduce the likelihood that I'm right. I also reduce my premium. I also reduce a lot of things like delta and things like that. So it's a higher risk scenario in this example to buy a strike price at $13 this far out of the money, even though it's going to save me some money on the premium. Why? Because the likelihood that it moves that way that fast in a short amount of time is low. So there are option sellers out there that are saying, you know what, I will sell you that option because the likelihood that you're right is low. The likelihood that you're wrong is high, which means as a seller, I'm going to make more money. If you don't understand the options buying and selling, we can talk one-on-one if you'd like to dig into. There's a lot of resources here at VantagePoint. We can also help from an options trading standpoint in the software. But if you're looking to get into options, just understand the pieces of options trading before you get into options. Right now, we're talking about strike price. So for me, the ideal strike price is right here at the money. Now, I can also increase the pace at which I make money and increase my premium by buying it in the money. Let's say I bought an 11 down here, it's off the chart, but let's say I bought an $11 call. That would be an in the money call because prices are at 12 bucks and I'm buying it down here at 11. That could cost me $2, right? $2 per share in the money from a premium standpoint. So where an out of the money premium in this example, and these are hypothetical examples, may have cost me for one contract $40, and at the money would have cost me $100 in premium. A deep in the money like $11 would have cost me, let's call it $200 in premium. All by selecting a strike price that is either out of the money from the current value of that stock or in the money or at the money. In my opinion, the one that gives me the best opportunity to make money at the pace that matches my trade plan, that's the $12. Now, this is not trading advice. This is from an educational standpoint. That's the one that matches the premium expectations. That's the one that matches what I'm looking for in this scenario. Understand, this could be different for a lot of different stocks. Well, let's say we use that example where 2% of a trade account is, $2,000. Well, if that premium is going to cost me $100 at the money, and one call contract is 100 shares, how many contracts can I buy? Well, we just do simple math and say that's easy, 20 contracts, right? 20 contracts is going to cost me $200 in that case, and in that situation, I'm controlling 2,000 shares of Ford, all right? Understanding that that's the case, if Ford goes up and I am right, well then I'm making the difference. I'm making the difference of $12 and what Ford goes up to times 2,000 shares. And it still only costs me that $2,000, right? 20 contracts, and we're talking $100 per. All right, so let's fast forward now. Let's move forward in time, one day at a time. There's one day, basically stayed the same. It opened a little bit higher, came down. So time decay is probably taking a little bit of my value. And by the way, from an options trading standpoint, I've selected my strike price. The other piece I needed to select is expiration date. An easy expiration date I like to use anything 45 to 60 days in advance. So if this was, 8/29, then I'm looking for an expiration date in October. So maybe the October monthly expiration would work for me, which means it has to get higher by that expiration for me to make money. It's already at the money, and right now, one day in, we are in the money because that price opened higher and closed higher than $12, which was that strike price. Let's fast forward one more day. There we go. We got to open and a close higher, so I'm in the money even further, making more money. I'm 3 days in. 2 days in. Now I'm 3 days in, and 3 days in, that stock is already, the close of that day is $12.14. So think about that. It's gone up, let's call it 11 cents. 11 cents. Now, for those of you that are good with math, and you know if I'm controlling 2,000 shares and I made 11 cents, I'm getting my calculator so I'm not wrong, then I'm already right. I'm already making money to the tune of $220. Now, remember, that premium was $2,000. I'm already up 10% in 3 days because the AI gave me that forecast. Now, obviously, we got to take that premium into consideration, but you got to understand that I'm already making money in this example because of the strike price that I chose at the point that the artificial intelligence said, hey, this trend is expected to move higher over the next 3 days. You can see it's already moving higher as I fast forward here in time. Go forward a little bit further. I've given back some of my value. It came back some again. So maybe I'm at a break even, maybe even a losing point. But the blue line, highlight this. Look, the blue line is still above that gray line. The shaded area is still green, the artificial intelligence. And I have until expiration in October, right? Expirations in October. The third week of October is what? Let's get my calendar here. Friday, October 20th. So I have until October 20th on this option for it to continue increasing in value so that I can make some more money. So the blue line still hasn't crossed. The blue line still hasn't crossed. It drew down and then bang, look at this big boom. Big, huge day. Now the close of this price is 12:30. Remember, if I bought my call with an expiration of October 20th and a strike price of $12, this is a very valuable day to me. Keep on rolling forward, and we can see rolling forward all the way until this is the close yesterday. Yesterday, Ford closed at $12.45. This thing's already up 42 cents from that forecast. 2,000 shares times 42 cents. Now, obviously, time decay has hurt us a little bit here. So I'm giving you some hypothetical numbers, but times 0.42, $840. Take some time. Take some off for time, because the longer it takes to go up, the closer you get to your expiration, the less value there is in that move. And in this case, you're probably up $500-600 on that option. Well, guess what? That option, that premium cost you $2,000. That means you're up 15-20% just in a week or two. This is why I love options. And because the artificial intelligence in this case gave me the opportunity to know when this trend is expected to move higher, I know the right time. Now, the question you might be asking is, how do I know whether to buy in the money, at the money, or deep in the money? How do I use the AI, not only from a timing standpoint, help me determine that? Well, let me show you. Look right here on the screen. In the software that I use, in VantagePoint, I have this gray bar that has a red and a green end on it. You can see it in this case on Ford. This is the predicted high and predicted low. And in VantagePoint, you get access to that information every single day for every single stock or market that's available in VantagePoint. This is what I utilize to help me determine, from a strike price standpoint, which strike price is going to give me the best opportunity to make the most money the quickest. And then I can compare that to my money management rules. But this indicator, these two indicators, the predicted high and predicted low, is one of the things that I'm going to use in order to do that. It's one of the key things that I use in VantagePoint, because the AI is doing global market analysis on Ford to determine what the predicted high and predicted low is. Let me show you what I mean. I'm going to go really quickly into the market details. See, to figure out all of this stuff for Ford, the artificial intelligence is going to look at Ford, and then it's going to look at Sony. It's going to look at all of these markets, Enphase, Activision. Heck, it's going to look at the Japanese yen. It's going to look at the Qs. It's going to look at Learjet, right? It's going to look at all of these. There's over 30 markets on this list. The AI is looking at these because what the neural network is capable of is analyzing over 10,000 markets around the world to figure out what is influencing, in this case, Ford. These could be driving Ford up, could be driving Ford sideways, could be pushing Ford lower. The AI knows all of that, and every single one of these markets is weighted by degree of impact. This is why I rely on it, because if it can do all of that, and this is a patented technology, by the way, but if it can do all of that and tell me when Ford is expected to reverse and what the predicted high and predicted forward could be for the next day, well, determining whether I'm buying a call, determining whether I'm buying a put, which strike price I could buy, all of that can be improved and enhanced because of this artificial intelligence process. This is called intermarket analysis, right? So that's why I'm using this. So how do I use that predicted high and predicted low, right? How do I dig in on that information? Well, remember, what we were talking about was the crossover right here on this day, which means I would have gotten that predicted high and predicted low for the next trade day on that day in advance. Well, I can then use it at that point. Now, let me show you something. Let me show you, I'm going to show you what I like. I'm going to look back on the predicted high and predicted low, but I'm going to put these two lines on the chart, right? I put a green line on the chart and I put a red line on the chart. And what I'm showing you with these lines is what the AI was predicting for that predicted high and predicted low looking back in time. This was the crossover date. The predicted high was nailed almost to a T. And the reason I say that is because that green line shows me where that predicted candle would have been. That predicted high was right at 12 bucks. If I picked a strike price that was up here at 13, that's way out of the money. And you can see I would have not have been close to that strike price the next trade day. I want to use a strike price that is touching that predicted high and predicted low that next trade day, because that increases the chances I get into the money very quickly. I'm going to show you an example of this right now on something called waste management. All right, I just flipped charts and you can see on waste management, you can see last night at 6:30 p.m. Eastern time. What do you see here? What do you see happen on waste management? We got a fresh crossover. The blue line was below, and then it crossed above right here on waste management. We can see that. There's other indicators that help me confirm that this is a great crossover opportunity where this trend is expected to move higher. For those of you that don't use VantagePoint, this is a key thing I'm looking for. All right, for those of you that do, you know the blue line crossing above, the neural index being green, and the predictive differences pointing higher and being through that center line is an optimal bullish prediction from the artificial intelligence. That is money in the bank. So at 6:30 last night, I could see that waste management was expected to move higher. The other thing I see is that predicted gray bar today for waste management. Now I got this at 6:30 last night, so I'm walking you through the analysis that would have been done as soon as this forecast came out. And look, the predicted high is expected to be higher, right? The predicted low is expected to be higher. And I know that because this gray bar has a green shaded end and a green shaded end. So it's this software, this is why I love using it. I've been using this technology for going on 12 years now. And you know, there's really nothing better, in my opinion, for determining trend changes and trend direction and timing of entries and exits and stop losses and money management and finding strike prices. This is my go-to, as you can tell. And in this case, what I'm seeing is all bullishness from the artificial intelligence forecast. There is 1, 2, 3, 4, 5, 6 with the predicted high and 7 with the predicted low. There are 7 predictive indicators that at 6:30 last night said waste management excuse me, is expected to increase in value. Well, think about that. As an options trader, do me a favor, go to the questions box really quickly. Tell me, if you're an options trader and you know with accuracy up to 87.4% that waste management is expected to move higher, do you think with 87% accuracy, up to 87%, do you think that information can help you determine now is a good time, or last night at 6:30 was a good time to set up buying a call, going a long call in waste management if it meets your trade plan, your trade criteria? You can answer me in the questions box. I'm curious to know, for those of you that use VantagePoint or don't use VantagePoint, seeing something like that and knowing that accuracy is there, could that help you? Because when I see something like that, if the answer to that is yes, tell me in the questions box. If the answer to that is no, tell me in the questions box. This is a live session. I'm open to all conversation. But if you ask me that, if you said, hey, Daniel, knowing that that trend is expected to move higher with that degree of accuracy, let me show you again. If I know that all these 7 predictive indicators are in agreement that waste management is expected to move higher, is that information that would help me be more successful in the markets? I tell you, yes, absolutely, right? And I didn't do anything fancy. I simply scanned for a fresh opportunity. You see, there's a tool in VantagePoint that'll go find these opportunities and present them to me. At 6:30 last night, this came out of a fresh bullish scan, meaning a scan that said, hey, these things are expected to move higher. Rico, I love it. Rico says, I use the software and I say yes. Rob says yes. Arthur, of course. Arthur, I can tell in your answer, Arthur, that you're saying that was an obvious question, and it might have been. Maybe it was rhetorical. But Jimmy says yes, yes. Really what I want is you guys to talk to me. That's what I want, right? I love it when you guys get involved. in the questions box, in the chat box, and get involved in this conversation, because from an educational standpoint, this helps me understand that, we're doing some good here at VantagePoint. So, hey, Gigi, yes, okay, good. All right, so we're on the same page then. We're on the same page. That's valuable information. So what the heck would I do at this point? All right, take a look. I use that predicted high and predicted low. If I put my cursor on that predicted high and predicted low, in the top left corner, I can see a predicted high of 159.44 and a predicted low of 157.89, right? 159.44 and 157.89. Well, that gives me some parameters to say, if I'm going to buy an at-the-money call option, the close of this was 158.58. The likelihood that I have a strike price at 158.58 is low. I might have a 158.50, I might have a 159, I might have a 160. But here's the key. Knowing that that close was 158.58 right here on that day, right? Knowing that that's the case, and knowing I've got a predicted high and a predicted low. Right here, I'm gonna do? I'm gonna put some lines on this. I am just gonna mark the predicted high with a white line roughly, right? And I'm going to mark the predicted low with a white line roughly, for those of you that don't use VantagePoint, so that you can see where those levels are. In an ideal world, I'm only looking for a strike price in between those two lines. Why? Because I am using the artificial intelligence and VantagePoint to increase the odds that I'm right, and I'm right now. Meaning within 24 hours, I want to be in the money within this option. My expiration still is out to October 20th, because remember, I can close that option at any time I want before October 20th. I don't have to wait to October 20th. I can decide tomorrow, Monday, week and a half from now. This hit my target, it's done enough, or the artificial intelligence is saying this trend is expected to end. I can make whatever exit opportunity or whatever exit decision I want at any time I want, as long as it's before October 20th. So in this case, what I'm looking for is a strike price that is no further out of the money than 159.45. And I can buy a strike price either at the money or in the money, as long as it meets my trade plan or my risk tolerances, okay? And that's the one key thing that I want to make sure that I'm doing is I am not buying out of the money so far that it is above that predicted high. Why would I do that? Well, I'll answer that. Some of you might say, I buy out of the money that far to reduce my premium. Well, you're also reducing your delta. You're also reducing how much money you make on the dollar. At the money, gives me the best opportunity to make the most on the dollar. We're not going to get into delta today, but if I lower my premium so much that I buy so far out of the money that I'm not really making that much on the option, doesn't mean I couldn't make more, but what I'm doing is I'm really increasing the risk. The last time, let's say I get a strike price that's at 160. The last time this was at 160 was, maybe it was 160 here, I don't know, but let's look. Nope, didn't get to 160 there. There we go. High, 160.55. That was 817. So the last time it was at 160 was a month ago. Do I really want to set a strike price out that far, saying, you know what, if I go above that predicted high, it could take a month to get there? Doesn't mean it's going to. We're talking about probabilities. So to use the artificial intelligence in a way that gives me the best opportunity to be the most successful, I'm going to pick a strike price that is within that gray bar or lower than that gray bar, deeper in the money if I'm looking at a long call. Well, let's say I get one that's 158, 159. It's probably about $4 a share in that situation. So one options contract on this at the money would cost me about $400, right? For one contract, controlling 100 shares if I buy at the money. Well, if I have a $2,000, my money management rules say I can put $2,000, I can lose $2,000 in any position I take. Well, then that means I can buy, let's call that 2 to 3. Let's go 2, because that would be $800, right? That means I'm controlling 200 shares of waste management if I buy an at or near the money call. an at or near the money strike. 2 contracts controlling 200 shares. All right, we got the math, and it cost me $800 to take that position. What I need this to do is to go up. And if it goes up, the difference between where it was and where it is and my strike price is going to be determine the amount of money that I make. In this case, it looks like Steve in the chat. Thank you, Steve. In the chat, he says $1.60, $160.06. That must be where it's at right now. It's up $1.54. Well, if it's at 160 right now, roughly, right about there, and I bought an in-the-money call option, then that means if I bought a 159 strike or a 158 strike or a 158.50 strike or whatever the case is, I'm already in the money. I've already made a ton of gains. Already talking about from the close, it's up $1.54 roughly, times 200 shares. Let's get out the trusty calculator. 200 times $1.54, because that's how many shares I'm controlling. That $800 premium could be up already $250, $300, right? Good. I use diff above 0 as bullish and below the direction, Bob. So Bob's question is about the predictive differences. Above 0 is bullish and below 0. Bob, it's the direction it's pointing. We need a positive rate of change or a positive slope to the lines for bullish. Bearish slope to the lines, they'd be going down. Yes, above 0 is even stronger, and we have them all at or above 0, but more importantly, they're all pointed up. The rate of change or the slope of those lines is bullish, Bob. So just wanted to clarify that. Bob, you're obviously a software user, which I love. Thank you for getting involved in these questions. You've got VantagePoint. You're part of the VantagePoint family. If there's anybody in here that wants to be part of the VantagePoint family after walking through the value in this AI and you don't know how, go to VantagePointForecast.com. You can click on the link in the chat. We'd love to answer your questions. Obviously, no obligation, but that gives us the ability to understand what questions you have. All right. All right. So this is a very valuable option at this point. It's already up, probably what, 30%, 40% on the day, just with the move in waste management moving up to 160. And how did I know that was going to happen? Well, at 6:30 last night, VantagePoint said that this trend is expected to move higher. And as long as I got an open somewhere within that candle, I can get my fill and ride that trend up and be up, 20, 30% on that option in day one. That's just day one using the artificial intelligence. All right. So that is a current example walking through exactly how I do that. Now, if you're a VantagePoint user, we even have a tool called Strike Price in the software. If you've already got the software, this is something that you can add on if you choose to. And in this case, you can see it puts some lines on the screen to show me the strike prices. For those of you that are a VantagePoint family member, take a look. I added strike prices to the screen. Now, VantagePoint is not an executional platform, so you're not going to trade from it. But at 6:30 last night, it identified a strike price at 160. It also identified a strike price, looks like at 157.50, right in that range. You can see that. It put the lines on the chart. And the green lines tell me which ones are already in the money, and the red lines tell me which ones are out of the money. This would be out of the money, and this would be in the money. We don't really have anything at the money. This is the closest thing to at the money, but it's slightly in the money. So in this situation, my strike price would have been here, and the move past 160 would have made some substantial gains in day one. Like I said, 30, 40% already, right? Yes, sir. Good. Glad to hear that. Glad to hear that. All right. Steve's one of our VantagePoint family members, and he put a note in the chat that says, one of the strategies that he and I talk about on a consistent basis, fired this 2 days ago and has been able to do well. So good job, my friend. And that's the great thing about this software. You can customize it and utilize it in a way that suits you. Steve's talking about grabbing some earlier entries and some quicker trends. You can certainly do that and apply this same strategy. For instance, using that short-term crossover, identified it a little bit sooner. Now you can see that the predictive differences, these indicators were not through that. For Bob, they were not through that 0 line yet, but still pointed up. Steve is talking about how this is something that would have fired for him sooner, bringing him profits faster, earlier. That is a strategy that he utilizes. Thank you, Steve, for putting that in the chat box. That makes it Very, very customizable. All right, let's look at another one. Here's UEC, Uranium Energy. Uranium Energy had a fresh forecast back here. Let's deploy that same strategy on 7/19. We can see that. Look, bullish, 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 bullish. We can go put our predicted high and predicted low lines right on that chart on that day, and we can see bullish and bullish. So everything was saying expected to move higher, right? So our strike prices we'd be looking for on uranium would be the predicted high on that day, $3.48, predicted low $3.27. So I would need a strike price somewhere around $3, $4, whatever the case is. That would be the strike price. If I go to a strike price above that predicted high at $4, it's way up here, right? If I got one at $3.25, great. Likelihood is I'm getting one around $3 or lower. I'm getting a strike price that's deeper in the money. And had we used the strategy that we're talking about at that crossover point, you can see that this stock is now up around $5 a share, roughly. The underlying asset moved 48% in the last 38 trading days. Getting an expiration of not August, but the end of September means there's still time left in this, and this option is probably up a couple of 100% from that crossover using the strategy that we just walked through together as a group. Does this work on other stocks? Absolutely. As a matter of fact, if you want to pop in some stocks into the chat box, I'm happy to pull them up and we can walk through some strategies. Maybe there's a stock you're thinking about buying options on. Pop it into the chat box. I'll just put the ticker in or the name, whatever the case is. I'll bring it up in the VantagePoint software. And as a group live right here in the software, we can walk through whatever stocks you want to walk through. We'll probably have time to do five or six of them. So go to the chat box now that we've kind of walked through in detail how to set strike prices using the artificial intelligence and increase your chances of being right or higher, and it happens sooner. Let's take a look at some other opportunities out there. Happy to do that for you guys as well. Let's see. Let me take a look at the chat box over here, see if we got anything coming through. MU, I probably could have guessed that one. A lot of options traders love to trade Micron. Love to trade Micron. So let's talk about the forecast in Micron. That happened on 8/28. So Bob, I see your request for Micron. MU, VantagePoint indicated that uptrend on 8/28. If I look at where my predicted high and predicted low was that next day, my strike price, I would have been looking for a strike price between 66 and 64.54 on that day. Right, so using that strategy that we just walked through, we'd be looking for a strike price probably around that $65 mark, right? That would give me a strike price that's right at the money. I could go deeper in the money if I want to. The question is, do I get that fill that next day? Certainly do. And then from there, Bob, that trend, I don't know if you bought that option at that point, but that trend is up substantial, right? Well, what does VantagePoint say about MU right now to understand whether or not this trend is expected to continue moving higher? Well, if I'm managing this position, I can see that the blue line is above the black line and forecasted to move higher. I think everybody can probably see that as well, right? Matter of fact, the predicted trading range says there's a chance that prices could go lower, but also be much higher than the close. I can see my neural index is green. I don't have to, by the way, I don't have to do anything if I don't want to past seeing the blue line is above. Why? Because I'm managing that position. If that blue line is above that gray line or the shaded area is green, that tells me that MU is expected to continue moving higher today. I can certainly use stop losses to protect my downside. Maybe I've already hit my Bob, I don't know if you have or not. You've already hit your target because this is a very quick move to the upside from an options trading standpoint. You can see that having 1 or 2 contracts of that or 10 contracts of that would have produced very, very well in the last few days, last couple of weeks. And even today, it's expected to continue higher. I don't know, Bob, if you took that trend or not, but if you want to let us know whether or not you did. Right now, I got to go look and see. Where is MU? I don't know. 71.28. So right now, Micron Technologies is bang, right there at that predicted high of the day. VantagePoint predicted a high of 71.31. It's at 71.28, 71.39. So Bob, had you been using this last night, you can see that VantagePoint's indicating that forecast right there, and it did exactly what VantagePoint told it to do. For those of you that have the software, you know it's kind of a funny joke that, you know, Micron did what VantagePoint told it to do at 6:30 last night. By the way, I think it's important to say nothing's perfect. So although we're seeing some perfect examples, and Bob asked for one that worked out perfectly, not always going to be the case, but I got to tell you, to have accuracy that's up to 87.4%, those odds are certainly in my favor from that standpoint. SPY, oh, we already brought up the SPY. Rico, we already looked at the SPY, and we can see from a trading standpoint, if you look at the SPY right now on the screen, you can see that we're getting major consolidation from the SPY. And, you know, the predicted high and predicted low expected to be, you know, the predicted high in VantagePoint on the SPY, you can see is top left corner, you can see 447.58. 447.58 is what VantagePoint said that we could expect from the SPY. So the question you got to ask yourself is, did the SPY move that high, right? Is it there? SPY's at 447.35. So this is a great example of where VantagePoint said you can expect prices to be kind of where they've been the last couple of days, and maybe a little higher, maybe a little bit lower, but doing exactly what it said. Now, we got a bearish forecast on the short-term on the medium-term crossover. If you go look at the long-term crossover, you got somewhat of a bullish consolidated forecast. If you go look at the triple crossover, you can see that prices are sitting right at the triple crossover, indicating more consolidation, and those lines are on top of each other. I'm not going to dig into the details of this today, but how do we know that we had consolidation in the SPY and it's sitting right at the predicted high? The artificial intelligence told us that. So Rico, I think you've probably seen that. Coin. Somebody's asking for coin here. Who is that? Damon. All right. Jimmy, I don't know, Jimmy, your question, the symbol I have on my screen that I added strike price isn't on your screen. I'm not sure which one you're talking about there. Is that waste management, WM? Which symbol, I guess, is what we're talking about. All right, here's Coinbase. What do we see from Coinbase right now on the screen? What do you, if you never touched VantagePoint before, what is the artificial intelligence saying about Coinbase right now? Go to the questions box, get involved. Maybe you have VantagePoint. Maybe you have VantagePoint. What's interesting about the profile of what the artificial intelligence is saying? Maybe you don't know exactly how to read it. Let me walk you through it, right? We got down on the crossover, but look at this. These lines are braided. Big trend up, big trend down, and then they're just going on top of each other. Consolidation. We see bearish here, but we see bullish here. We see bullish here, but bearish here and bearish here, and bearish here and bearish here. So I've got some bullish, I've got some bearishness. If somebody told you, it could be bullish, could be bearish, what direction would you expect Coinbase to go? There you go, Mojo. Mojo jumped into the chat box, said sideways. Absolutely. The AI is saying we could see prices, predicted high and predicted low, right? Predicted high in this case are 81.94, predicted low 77.54. If we go look at coin right now, you can see that it is slightly a bit higher and it is sideways. It is exactly where it's been. Heck, it was just there 2 days ago, 3 days ago, a week ago. It's sideways. No ifs, ands, or buts about it. This stock, from an options trading standpoint, is fantastic for you option sellers out there. Why? You can sell the 88 call. You can sell, a put that's at 75. You can sell these positions and collect a premium. Why? Because there is consolidation expected in coin. Regardless of whether you're an option buyer or an option seller, VantagePoint's artificial intelligence will give you that leg up, and you can see that that's the case with consolidation. You're very, very welcome. Glad you tossed that one in there. All right, let me look. What else we got? AMD, Apple, a lot of tech. All right. A lot of tech believers out there. That's good. Here's AMD. forecast on AMD. When you look at this, you can see that there is some, again, uncertainty in AMD. We got a predicted high that could be over 106.66. We got a medium-term crossover that's saying bearish. We got a long-term crossover that's saying consolidated. Right? You guys are seeing that. We got a short-term. Oh, let me go back to the short-term crossover. What is that saying? Oh, consolidation. That short-term crossover is flattening. We got bullishness with this predictive difference, but bearishness with these two, and the neural index is bearish. So I got, again, more consolidation with AMD, more sideways expectation, a little bit of bullishness based on the fact that the long term is still there and bullish. Oh, let's go look at the triple cross. Oh, triple cross is saying bearish. So again, from a tech standpoint, a lot of mix up in the indicators. The indicators are not in agreement saying, hey, you know what, higher risk opportunity, consolidation expected. Heck, you could even say that there was bearishness expected, and we're probably not getting that on AMD today, which goes to show you that the consolidation that's happening from a tech standpoint is real consolidation, and you've got to use it in your decision making. Let me see some of the questions. Few weeks, selling synthetic stock using acquirers going further out. You can certainly do that, absolutely. Sideways, says Scott. I just want to read some of these chats in here, make sure I'm not missing anything. Apple. Okay. Bearish, bearish, bearish. That's what VantagePoint is saying about the expectation for Apple today, that there was bearishness expected. We got a predicted low that could go down as low as 174.90. We do have a little bit, one little bullish short-term predictive difference here. So Apple's not going to fall through the floor, but it certainly has some bearish expectation down at 174.77 is the predicted low, with a predicted high of 178.82. So we would expect to see Apple right within that range based on what VantagePoint is saying. And I think if I remember from this morning, that's probably where Apple was. And I don't, unless something's happened in the last hour we've been talking, I wouldn't expect anything different than what VantagePoint indicated. IBM. Guys, we're spending a lot on tech opportunities here. We're going to get the same kind of scenario from tech opportunities. There's a great bullish trend on IBM 823. The question is whether or not IBM is expected to continue higher. Well, here's the thing. We don't have a crossover in that medium-term crossover, but we do have a predicted low and a predicted high that's expected to be lower, which means prices are expected to be lower. We've got a red neural index, and all the predictive differences are pointed down. Although we don't have a crossover from that short term, you can look at this and say, you know what? If I bought a call at that point that Daniel was educating us on, I can see that it's clearly at a point that there's a profit-taking opportunity. If you haven't already taken your profits on IBM, what the artificial intelligence is saying that this trend is weakening dramatically to the point that you've got to think about mitigating losses. If you hold IBM long, maybe it's a cover call opportunity. It's maybe a exit part of that position. Heck, if you bought a call back here when this crossover said it was expected to trend up, this is the software saying the majority of the indicators are indicating some bearishness on IBM. A profit-taking opportunity is upon us. I'm not telling you what to do, neither is the software. This is artificial intelligence indicating there is weakening in IBM. Prices are expected to be at or lower than they were recently. And the AI with accuracy that high, hey, you don't have to scream at me to convince me to take some gains out of a trend that's been very, very productive, right? And you can see that that's the case, Mojo, from an IBM standpoint. He was the one that put in that chat into the box. So no movement. Yeah, time decay is big. Sideways. Yeah, if you're an option seller, you want time decay, Scott. I think we were talking about this. If you're an option seller and this thing goes sideways, you are collecting premium all the way through that because it just goes sideways. As an options buyer, you don't want that time decay, right? As an option seller, you do, because that means you're likely going to keep that premium. Bob says, VantagePoint was to the penny on CGC yesterday. Very volatile. I didn't look at CGC, Bob, but let's look at it. Canopy growth, you said to the penny yesterday. Look at that. Look at that forecast. That's a powerful forecast on canopy growth, and you said it was to the penny. Up to the close yesterday, look at that. That's a 153% gain since that forecast in 8 trading days. 153% in 8 trading days since VantagePoint said that trend is expected to start going up. That's 153% this month alone. Thanks for bringing that to my attention there, Bob. I didn't see that one before, but I'm glad you brought it up. Guys, we're out of time. I'm going to do one more. Scott entered ABBV. Let me see. Scott said, I just entered ABBV. 150 call, 929 expiration, 150 call. So you bought an out of the money call right at that predicted high. The predicted high is 149.99, so I can see why you went out of the money. You saved a little bit on premium, but it's still basically touching that predicted high and predicted low. You said VantagePoint gave entry point, paid $3, bought 5 contracts. All right. So this is something that Scott got out of VantagePoint with a 150 call, bought 5 contracts, $3. For those of you that are new to options traders, $3 per share times 5 contracts or times 500, right? That's a $1,500 position. Scott's, thank you for sharing that information with us. And Scott's expecting it to go to above 150 on this stock. VantagePoint forecasts that trend to go higher. Why? Because the blue line is above, the Neural Index is green. 2 of the 3 predictive differences are pointed up. 1 is pointed down. That was enough for Scott to say, I have enough bullishness. I'm okay trading $1,500 in premium on ABBV with a 150 call. ABBV is at 151.36. 151.36, so it is up here already. And we can see from a different standpoint from that point to roughly where it is now. There you go, $1.18 per share, again, roughly. We're talking about 500 shares. So if we took, let's just do easy math, $1 per share times 500 shares, that's simply $500 in gains from that strike to where it is right now. That is a 30% or more gain in one trade day using VantagePoint based on how Scott just used it, and Scott's a user of the software, based on how he just used it in that asset alone. Thank you, Scott. I appreciate you being willing to share that information. Always, always very, very valuable. Out of time. Thank you. For those of you that are part of the VantagePoint family, thank you for being part of the VantagePoint family. For those of you that are watching this from an educational standpoint or thinking about bringing AI, don't forget, you can go to VantagePointForecast.com. We would be happy to answer your questions about the AI, about how this has been helping traders, give you some background information. And if you want to get started with us, let us know. Otherwise, we will be here again in a couple of weeks. Subscribe to this channel. We do these lives every couple of weeks, different topics, different information, different conversations, whatever we can do to put the odds and stack the odds in your favor and help you understand the markets a little bit better. We're happy to do. So thanks for your time, and thank you for letting me give you the view from my vantage point. Have a good day, everybody.